Hi everyone, my name is Lena Castanos and I will be moderating today's webinar. I will begin by introducing the Capital Pathways program. Then I will introduce myself and give the word to our guest speaker, Kara Glasheen, Business Advisor at the Capital Regions SBDC, who will introduce herself and take us through a presentation on understanding your financial statements. Feel free to ask any questions through the Q&A function throughout the presentation. We will be responding to them as we go. The questions that we cannot respond to in this webinar, we are happy to address through our no-cost one-on-one services or connect you to resources that can help. We will share a recording and slides of this webinar afterwards. So, what is the Capital Pathways program? It is a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity and hosted by the Virginia SBDC and George Mason University. We can start with a program overview, then we will go through the program eligibility and finalize with its services. Capital Pathways is a no-cost specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. Why does it matter? Being capital ready matters because those less prepared self-select out of or fail applications. Early failures correlate to lack of adequate capital. Higher cost alternatives don't build long-term capacity. Only half of requested amounts reach small businesses. To put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, just 20 to 30% of those who apply for loans actually get their loans approved. Capital Pathways creates a path to financial and legal readiness. Our program offers an immersive hands-on group experience paired with one-on-one support. Who is eligible? Very small businesses at any stage facing challenges accessing traditional financing. The services that we provide include a guided self-assessment, legal structure validation, financial skills and tools, and loan application readiness. We start with a self-assessment that pinpoints your business key gaps so we can connect you with the right tailored resources either through our Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through more basic legal questions, and we partner with a law firm which can help you for more complex topics related to business registrations, trademarks, and contracts and agreement reviews. We also offer financial webinars on topics such as financial basics, financial statement preparation, like today's, and analysis, and QuickBooks training. Another one of our offerings include one-on-one individualized and tailored support on business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender prep. Finally, our loan application readiness services include both webinars and one-on-one individualized support. The webinars are on topics such as what lenders look for in loan applications, interactive mock loan interviews and sample application analyses, and SBA loan options. We also have a partnership with lenders that provide one-on-one support to those looking for capital. If you're interested in getting started, you can reach out through our website at virginiasbdc.com/program/capital-pathways. And you can also scan this QR code. All right. Kara, do you mind sharing your screen?
I sent a request.
Wonderful.
All right, here we go. Thank you, Lena, for the introduction. Um, as she stated, we're going to be handling Q&A throughout. We're going to pause after some of these major sections. And as Lena also stated, you're going to have access to the recording and slides. And with the slides, I'll also have a link to a supplemental document that can help as you're reviewing this on your own. And I definitely recommend reviewing this on your own a little bit. So let's jump into it. Just in case you don't know where you are, this is the Financial Statements Bootcamp. This is Know Your Numbers. And what we're looking at today is how to read and use your financial statements. Now, in theory, I would love if this is building on your Capital Pathways foundations. Perhaps you attended a webinar, a webinar I gave previously on financial basics, which is just getting yourself set up with some best practices around financial tracking. You maybe have also attended one of the QuickBooks 101 or 201 webinars to help know how to use QuickBooks software. And hopefully this webinar is designed for people that already have some systems generating their financial data. They're already doing some sort of financial tracking, but maybe you're trying to understand what these reports are really telling you. So that's today's goal, is to help you understand and use and just be more confident using your financial statement information. So I'm going to frame this today through the eyes of this hypothetical business owner. He is Craig. He is a Virginia Beach-based landscape company owner. And maybe Craig is like you. He uses QuickBooks. And he actually has some fairly advanced accounting processes already at play because he uses QuickBooks for his invoicing. And when using QuickBooks for invoicing is actually a form of, it's called accrual-based accounting instead of our cash basis. We're going to go through what that means in a couple of slides. But he doesn't really understand how to use it. He's still filing his taxes on cash basis. Things can get messy. He maybe sees his financial statements through his bookkeeper. He gets to check them out, but maybe he just files them away. He doesn't look at them. He's maybe tried to apply for loans, but when bankers ask about ratios like DSCR, he doesn't know what they're talking about. And even more importantly, he doesn't even know if he can trust his financial statements or what they're telling them. So we are hoping that we can help Craig and you become more confident users of your financial data. Now, if this doesn't quite apply to you, maybe you're not using QuickBooks yet, or you're still working on getting it set up, you're still in the right place. I think being aware of these statements when you're still in that setup phase can really help you get your systems set up right. So our learning objectives today are that by the end of this session, again, you can understand exactly what is an income statement, also known as a profit and loss, what is a balance sheet, what is a statement of cash flow, and what do these show. I also hope that you'll be able to spot trends and any red flags in these reports, and we'll be able to navigate these numbers in a spreadsheet for your improved understanding. We want to use our financial data to potentially plan or pivot, or maybe you're planning on seeking funding soon. And hopefully we can use some of these quick diagnostic tools I will share that can help assess your business health. So today's structure, we're going to tackle each statement separately and then bring it all together. And this is a warning. Lena asked me to have this seminar as a boot camp. So we're going to be covering some tough topics. I definitely recommend coming back to this webinar, watching it multiple times if needed, and don't be shy in the Q&A section. So what are our 3 financial statements? I want you to think about this like your car dashboard. So of course we've got our speedometer. This is answering the question, how fast am I going? This is like our income statement, which is telling us how much am I earning? How profitable is my company? But if that's all you had was your speedometer, you're missing some information. We also have our fuel gauge, which is telling us how much further will my car make it? How much further will my business make it? Do I have enough cash to get where I'm going? And then we want to know, is everything healthy? This is like our temperature gauge or our balance sheet. Are you financially stable? Is the engine working properly? Are there any things that we need to pay immediate attention to? So just like operating a vehicle, we need all three of these to make safe decisions. A little background before we go into our financial statements. I do want to cover what is cash or accrual basis accounting. So we have basically these two methods, but I also want to share that there is a hybrid approach. Accrual basis accounting is when you are recording your revenue based off of when it's earned. So this is maybe like when you send an invoice, it might appear, assuming you do the job then, that might not actually time with when your customers pay you. So cash basis accounting is the much simpler version where all we need to see is really your bank account. When is the money coming in? When is it leaving? This is how basically all small businesses file their taxes. And when it comes to small business accounting methods, most of you are probably using a pure cash basis system, meaning we're just worrying about cash in, cash out. But many of you may also be using some accrual type methods, such as Craig. So Craig is using QuickBooks, and he's sending invoices to customers through QuickBooks. He's also receiving invoices from his vendors through QuickBooks. And so this creates a little bit more complexity, but it also allows him to see a more accurate view of profitability. And so we end up in this hybrid approach, which can get really confusing for business owners because you still end up filing your taxes annually on the cash basis. So I know this is a tricky topic here, but I wanted to share an example of a business with some of these more intermediate accounting practices using a hybrid accrual cash basis type reports. But even if you're still just using cash basis, which I recommend as long as it works for your business, keep things simple. The concepts we cover will apply to however you're handling your financials. So now getting into really the first major section, this is the income statement. This is probably the statement that you all are most familiar with. This is basically your performance report card. Now, first, your income statement is known by multiple names. It is also called a profit and loss statement. I will frequently shorthand it to your P&L. So this is answering the question, how did my business perform over a specific time period? So we're never looking at your income statement over one day. We might be looking at it over a month, maybe over multiple months, maybe over a year. And it's going to be showing basically a movie of that performance, not just a point in time snapshot. The basic formula to our income statement is your revenue, your earned cash in, subtracting out your expenses, and that's going to give you your net income. But of course, it's a little bit more nuanced. So next page, we have an example, 1 month, the May income statement for Craig's business. And this is broken up into the following sections. Most profit and loss statements, income statements are going to be broken up like this, although all of the categories may or may not apply to your business. Typically, we see that income section first, and that should be earned revenues split up by types of income. So for his business, he's got design, landscaping, maintenance. Next, we see cost of goods sold. This is the cost that it costs you to deliver your product or service. So this is different from your operating expenses because they should be directly corresponding to that income, to that revenue. So not all businesses have cost of goods sold. If you're a sole proprietor and you're running a consulting business, really your only cost of goods sold is your time, but you're not tracking that separately. So this would be empty, it would be zero. Now, if you do have COGS, your gross profit is really important. This gross profit is your income minus your cost of goods sold, and it is what your company has left to pay for everything else it costs, your fixed costs or your operating expenses. Your operating expenses include things like rent, utilities, marketing, admin costs, other payroll if you have it, and just sort of general costs of operating your business. Now, sometimes we also have these other income expenses, and these might be money in or out, not directly related to operations. Sometimes I see folks include these in their income or in their expense categories, but it's really best to split out if it's things like credit card interest, or it's things that really did not relate to your day-to-day operations. So credit card rewards, stuff like that. So again, your things like your, I see the question coming in, I'm just going to address it quickly. Labor would be part of your operating expenses, assuming that it is a fixed cost like admin labor, but labor might also go into costs of goods sold if it is directly related to your income. So we can see labor in a few different places depending on your systems, your business, and how you're treating it. So if we, from here, we get to our first net operating income. This is the earned revenue minus your cost of goods sold, minus your operating expenses. And then separately, we might have this little category of smaller, less important stuff, again, like credit card rewards, other income, that'll get us to this true net income line. This is the actual result, cash in, cash out for your company for that particular month. Now, looking specifically at Craig's numbers, what we see here is his total revenue for this month was about $17,000, $16,800. And this is the sum of those three categories. We see his cost of goods sold at $8,400. And so we can see that his gross profit margin for this period, if the math is right, these are hypothetical generated statements. So if there's errors, it's my fault, but I think that math works. So his gross margin for this 1 month is 50%. And now, depending on your industry, maybe that's good, maybe that's bad. I recommend looking up online, what's a good gross margin for my type of company in my industry at my size? Because landscaping is fairly labor intensive, fairly supply intensive, 50% is probably okay. For every $1 of revenue Craig earns, 50 cents remain after his direct costs. So we also see here that the total operating costs of his business are about $3,800. And that gets us to this net margin percentage, which is what percentage of cash of what he brings in does he get to keep after paying for his cost of goods sold, after operating his business. It's 27%. And so according to industry standards, 27% is excellent for the landscaping industry. Now, if we go into some of the challenges with interpreting our statements, because as I mentioned, a lot of you are using cash basis, meaning, or at least a mix of cash basis and accrual accounting methods. So the timing might be a little bit weird. So for Craig's example, he records his income based on when the job is done, but maybe his customers pay after the job is done. So maybe there's a delay in that cash, but he pays for his materials as soon as he buys them. So there could be a bit of a mismatch. It's important to understand how these numbers are getting to your statements. And so when we look at multiple months in a row, and I recommend looking at multiple months in a row, the gross margin doesn't stay consistent. So we see in February, his gross margin looks really strong at 65%. And then March, it's 56, April, 55. We already know in May, it was 50. So what we should take from this is that for most small businesses, it's really helpful to look at these months all together and take an average across the months to truly understand what our margins look like for long-term planning. So again, more important to look at trends, not just 1 month in isolation. I see another question that came in, and that I'll just go ahead and address now, is where is Craig's salary? So we don't see Craig's salary in this at all, because Craig is a sole proprietor, and he's paying his taxes as a sole proprietor. He's an LLC, so he's taking owner draws. So for now, and maybe this is the right choice, maybe not, for now, we won't see Craig's pay in the income statement at all. It's not included. We can only see his pay on our statement of cash flows, which we'll get to later. So I also want to address some confusing terminology that we see in income statements. And sometimes we see different terms that kind of mean the same thing. Like here on this statement, you see net operating income, you also see net income. Sometimes net income is called net profit. This is basically the same thing, just with different names, and is referring to what's left after all of the expenses. But net operating income does have a different definition because of that word operating in the middle. And this is more relevant for tax forms, Schedule C for sole proprietors, and it's going to exclude those other income, other expense categories that, again, are not tied directly to business operations. So like you shouldn't be paying taxes, for example, on your credit card reward income in the same way you're paying taxes on your earned revenue. So what we see, we also can see a term called EBITDA, which is earnings before interest, taxes, depreciation, and amortization. This is a more technical term that maybe lenders use, investors might use, and it is showing more general operating performance before financing and equipment costs. And it can be used when you're looking at different businesses in the same industry to compare them without having to worry about the costs of those financing, costs of maybe they have different types of businesses, maybe there's taxes. So it's just meant to be a little bit more neutral, but technically it is different. So for Craig's business, our net operating income in this month is about 4,500, but our net income or our net profit is 46. And then our EBITDA, we add back in, let's see, it looks like we add back in the interest and depreciation costs that are here. And then that's how we get to this 5,655. So you don't need to be calculating these all the time. It depends on what you're using them for, but it's good to be familiar that they have slightly different meanings, they have slightly different uses. Now, quick aside, this is relating to that question about Craig's salary. And I wanted to touch on this quickly because it always generates questions. However, it is a very individual decision based off of your business, where you are in your business journey. The simplest, most flexible option, and what we would assume Craig's business is using, is that he is an LLC filing his taxes as a sole prop. So for him, his business profits are basically reported as personal income, and his net operating income is what is used to determine taxes. So the owner's draws he takes don't affect the taxes. If he left all of the cash and didn't actually take any cash out of his business account and was just growing it, he's still taxed on the profitability of his company. This is different if you choose to take an S Corp election, and this is still for an LLC. It is a tax election. It is not an entity change. And if you make this election, you are saying, not only am I the owner of the business, I'm also an employee. So I'm going to take a salary. Two, if you elect to file your taxes as an S Corp, you must take what the IRS calls a reasonable salary. And then that reasonable salary will appear on your income statement. And what's nice about this is then the salary becomes a tax deductible expense, and what remains is what's passed through to your personal taxes, but you don't have to pay self-employment tax on that remaining amount. So I know this is complicated. Typically, most businesses start in this category as a sole proprietorship, taking owner draws, paying taxes based off of the net operating income. And then as you grow, as your business becomes more stable, and as you become more profitable, it's going to make sense for you to switch yourself onto a salary and get those additional tax benefits. But the warning here is if you do this too soon before your business can really handle it, it's kind of hard to undo. And if you can't afford to pay your salary, it just creates a little bit of a mess. So, there's a reason to keep things simple while you can, and then adjust with time. You can elect to file your taxes as an S Corp up until March 31st of any given tax year. So we are in the end of October. For all of you, if you haven't made this decision yet, you don't have to make it for another 4 or 5 months. Although it is good to make in advance of the year if you're planning on switching yourself to salary next year. So if Craig elected to file his taxes as an S Corp, then he would be required to pay himself salary. So maybe that's $3,500 a month. That would reduce his net income, and he'd have additional payroll costs associated with that. But the remaining profit would still pass through for taxes at that lower rate. And I've got a plug. Lena and her team, they've got a webinar coming up on December 18th, all on this topic. So this can be a whole webinar in and of itself. Another tool that we can use to think about our expense control, call this the simple expense control rule, is that we should be watching our gross profit, because if what matters most to the business owner is cash, what you get to take home at the end of the day. I think a lot of business owners can get really focused in on sales and growing sales, but while their revenue might be going up, there's a chance that their costs are going up at the same rate. And so if we look at this example and this sort of time on our, on our x-axis, at this stage in the business where we have this blue triangle, we're seeing that our sales are in blue, our gross profit is in green, and our operating expenses is a stepwise function. So at this stage, all of this is our profit, right? But if we're not careful, as our revenue continues to grow and our gross profit also grows, our expenses are also growing, we can end up in a place where we're basically growing ourselves broke, where even though revenue has gone up and up and up, your expenses are also growing up too fast. So what we recommend is to watch the gross profit. And if you see your gross profit decrease, then make sure we're cutting operating expenses by that same amount. So if Craig's gross profit drops by $1,200, and from 1 month to the next, he can take that as an action to say, okay, I need to immediately cut a similar amount in my operating expenses. So these should be things that he has control over. Maybe he's driving too much, he can cut fuel costs. Maybe he's renting equipment that he doesn't need, he can cut that. Maybe it's a slow season and his advertising isn't working, he can cut that. So the goal, if we do this, then you're able to maintain the same level of profit, even if your sales are declining. So I recommend this because it keeps you profitable during tough periods, during slow periods. It forces you to look at your expenses and make these quick decisions to control your costs. And it can prevent this slow bleed that can often kill growing businesses. So it is not just top line revenue that we care about. Now, here is another tool that we can use. This is basically a way, if we're looking at a snapshot of our income statement, we can see our sales. Again, sales are what a lot of people chase. They're wanting to see sales growth increases, but we also want to pay attention to that gross profit, operating expenses, and of course our net profit. That's what we take home at the end of the day. We want to pay attention to what's happening in each of those categories. So for example, for Craig, from June to August, if we look at his trends, we see that his sales drops 2,500, which that's a first alert, but there's potential that he could be controlling his net profit during this time if he's being really cautious. However, we see his sales drop by 25, but his gross profit drops by 650. So that's not bad, but then his operating costs stay high. They only drop by 140. So the result is that his net profit has decreased by 510. So things could be worse, but this is something that a company should watch. Either should he have been working harder to keep sales high? Were there things that he could have done? Or could he have made more cuts to his operating expenses that could have kept him more profitable and would have landed him in a more comfortable category? So plenty to play with here. This is I think a fun tool to look at, to save, to pull up your statements and see what category you would fit in at any given time. I think this one is the best situation for a lot of business owners because you're seeing your sales increase. We love that, but we're also seeing improvements in your gross profits, which means you found a way to save on your cost of goods sold. And you've also found ways to decrease your operating expenses. So overall, your net profit should be climbing. So we could spend more time there. But again, this is a sheet that you could save and try to apply to your business. Now, that brings us to our first pause. That's probably the longest section. Happy to answer any questions that relate to P&L structure, interpreting specific numbers, cash basis, accrual basis, where to find industry benchmarks, anything else. And Lena, I've got the chat on this one. So questions going through. Again, we had that is labor and other expenses. No, labor is definitely an operating expense, but it's more complicated than that because we might have cost of goods sold labor. And if you include Craig's labor as the sole proprietor owner taking owner's draws, then labor could actually be in 3 places, right? In COGS, in operating salaries for maybe like an admin assistant, and as owner's draws.
Sorry about that, Kara. And then it said, when is Craig's salary expense? That's another question.
Owner's draws.
And then the next one would be, where do I find that tool sheet? I guess. Mm-hmm.
Yeah, slides will go out after this. It is a resource from a company called Cashflow Mike, and you can print it out, you can save it, and take a screenshot wherever.
Wonderful. Where can I find industry averages for my industry?
So this is a great thing to ask an SBDC or Capital Pathways advisor. We have access to some paid resources like Vertical IQ and IBIS World, and those are really great to get reports from. We'll share them with you directly. Those are going to be high quality reports, well researched and up to date. That being said, quick Google will give you a decent starting point, but I do recommend to keep in mind if you're looking for industry standards to pay attention to the size of business. What is standard for a $1 million company is very different for a $10 million company versus a $100,000 company. So
Thank you, Kara. Could you go over EBITDA? How is it calculated?
So EBITDA, if you can remember the acronym, which is already tricky, earnings before interest, taxes, depreciation, and amortization, it's telling you the formula itself. So earnings would be your operating expenses, and then but it is before the interest, taxes, and depreciation. So we have to subtract out interest. We don't have taxes here again because their taxes are sole prop. So nothing to subtract there. The depreciation we have here, and we don't have amortization. So if we had that, then we'd subtract those out as well.
Can you talk about the industry standards?
So I think that's what we covered, the
Yeah.
industry standards. It's just helpful because, for example, if a grocery store has really different expected margins than an e-commerce site, right? And a larger scale operation, can afford having smaller margins at the end, those profit margins. So knowing where you compare specifically for your industry can help clue you in on, is this normal for my industry, or am I outperforming? That'd be great. Or am I maybe not charging enough, which a lot of small businesses are guilty of.
Thank you. And I see Joseph asked something about music retail and lessons. Joseph, if you could explain a little bit more, that would be great, and we can help you.
There's that in another section
Mhm.
if there's more information. But for now,
Exactly.
let's move on to the next statement, our balance sheet. So the balance sheet, this is a financial snapshot. This is very different from our income statement because typically a balance sheet is as of a particular day. Most of the time, people are looking at balance sheets as of December 31st, 2025, the end of the year report for your business. However, you can pull a balance sheet as of any day, as of whatever today is, October 29th, 30th, I don't know, it's 29th. And it would, in theory, if your books are up to date, give you a current day of health report, essentially, of your business. In simple terms, the balance sheet is answering the question, what do I owe and what do I own, vice versa. Um, Now, this visualization is one way to think about is one way to help us remember another key concept with balance sheets, and that's that a balance sheet must balance. The sides that have to balance are that your assets, the stuff that you own, has to be equal to the liabilities and the equity that you have in your company. So again, assets is the stuff your business owns, liability is the money your business owes to others, and equity is what you've built over time. And we're going to go over that in more detail in each section. Using Craig's balance sheet as an example, I've recreated these same boxes. So we've got our assets on the left, all of the stuff that he owns. So this includes cash, assets, other fixed assets. And we've got liabilities on the top right. We see credit cards, we see equipment loans, and then we have equity in the bottom right, which is showing any money that he's invested, any money he's taken out. And then it's basically a running report card of all of your prior income statements. Your net income from prior years gets bundled up and put into retained earnings. And then your year to date net income comes in and fills out the rest. And of course, as I mentioned, the balance sheet must balance. So our total assets must be equal to our total liabilities and equity. So again, this is just broken out specifically for Craig's business. The most important asset for most small businesses is going to be cash. This should be reflecting your business bank accounts, not your personal bank accounts. This is why it's so important that your business bank accounts are the only ones linked in QuickBooks. And this should be a sum at a particular time of your checking and savings. Now, this means that if you look at your bank statements as of the same day of the balance sheet, the bank statement should reflect that same cash amount if your QuickBooks is up to date, if your accounting system is correct. These items in gray, remember I mentioned how Craig is using this hybrid accrual-based basis, some techniques. And so because of that, he has to worry about accounts receivables because he sends the invoices. When he sends the invoice goes on his P&L, but maybe the customer doesn't pay him right away. And this, our balance sheet is showing us how much do we have outstanding? How much do customers owe us? He also might use prepaid accounts. So businesses and their accountants might use prepaid accounts if you have really big annual expenses. Maybe you pay your insurance annually and you want to spread it out equally across the 12-month of coverage. So this is telling us how much cash he has left from that annual payment remaining on his balance sheet. So again, he owns 2 extra months of insurance that he doesn't have to pay for. He also has his equipment and vehicles summed up, all of the equipment that is expensive enough to be capitalized, and to depreciate with time. But then we also have to subtract out that depreciation. So it's the net value of his fixed assets. Liabilities, this is again what he owes. So he uses again this hybrid method. So his income statement would show some vendor bills that maybe he hasn't paid. So this is accounts payable is telling us that he owes vendors a sum of 6,800. Again, if you're not using like vendor bills in QuickBooks, so you're not using any of these accrual methods, you just won't have these three accounts on your balance sheet. If you do have these accounts, but you don't think you're doing these things, that can raise another red flag. We need to be, if you're going to be using these accounts, they should be watched because they're telling us important information used correctly. This is telling us that, Craig needs to be knocking on some doors, getting cash from customers. And maybe Craig's late on paying vendor bills, or maybe he just recently got a big bill. We don't know. But what a lot more business owners will have is that credit card balance. The credit card balance should be accurate per the credit card statement shown as a liability. So if that's not accurate, it's also showing that something is going wrong in your QuickBooks or your accounting system. Same thing, equipment loans. This should reflect actual remaining balances on principal of loans, and that's summed up together as the total cash he owes. So far, this is telling us that Craig has about 76K in assets, stuff he owns. He owes about 3,200 to others through equipment loans, credit cards, and vendor bills. And then he has built about $44,000 in worth. And again, this is going to be different depending on how you pay taxes because we use different terms if you're filing as a sole proprietorship or an S corp. But for Craig, he has owner investment, the cash in, which would be shown as paid in capital if you're using S corp terminology. Retained earnings, that's going to be the same. And then owner draws, which are called owner distributions if you were taking a salary. So again, a little confusing, but I do like to flag that the terminology does change and they do have slightly different meanings. So now I also want to say that if I am assessing somebody's QuickBooks, typically one of the first things I do is I go to their balance sheet. And the first thing I check is, does the cash on your balance sheet match what's in your bank account? So I'll look at your QuickBooks, I'll say, great, let's pull up your bank statements that match this period. And that if they match perfectly, then that gives me some reassurance that things are mostly on track. Still plenty of other things to dig into. That is a great first start. Next, you should really understand as a business owner what each account on your balance sheet describes. I've seen a lot of very messy balance sheets that all of a sudden there's all of these accounts that just accumulate over time because the business owner isn't watching it, and it can be hiding some weird things or duplicating different items or splitting up what shouldn't. So if you're working with a bookkeeper and they send you a balance sheet and you don't know what something is, absolutely ask and make sure you can, even if you don't know exactly, you should be able to generally describe the purpose. And then another thing to note is that most balance sheet accounts, you'll notice, are positive numbers. So if you see a negative number, let's try to understand why. There are some exceptions, like depreciation is always going to be negative because that's subtracting out of an asset. And then owner draws and owner distributions are also going to be negative because when you take an owner's draw, you are pulling equity out of the company. But as a counterexample, what is a negative credit card balance? Like, what does that mean? If we think about if a positive balance is money you owe to the credit card company, a negative balance would mean that the credit card company owes you money. And that is unfortunately unlikely. So let's take a look at this intentionally messy, chaotic balance sheet. And I'm going to pause for just a moment here while we look at this. And I want you all to try to identify at least two things that you as a business owner would call out to your bookkeeper or accountant, or something that you would be able to say, oof, that is wrong. Pausing. I'll take a sip of water. Now I'm going to click and I'm going to circle what the big issues are. Now, first is, well, we can't check here, does the cash equal our bank accounts? Because we don't have access to our bank statements. Again, this is a made up company, made up numbers. But we can see here that there's this weird thing going on, and I see this fairly frequently, that we've got savings account and then we've got savings account 1. This seems like, I see this happen when people accidentally disconnect a bank account and then reconnect it. And then sometimes we end up with these weird lingering balances. And so again, here we see that negative bank account number. Most banks won't let you have negative cash balances, at least not for long. So that is absolutely something to pay attention to. Again, as I mentioned, negative numbers don't make sense for a lot of balance sheet accounts. So for example, if our accounts receivables is negative, then that means, because again, accounts receivables are saying how much money do customers owe you. And so a negative number would mean the opposite, that you owe your customers $18,000, that you over collected. So again, this shows that something has gotten off in the way you've been invoicing. Something else I've seen is people will continue to accumulate depreciation beyond the value of an asset. So that ends up with a negative set, which you do not owe an additional 5,000 on this truck. It just doesn't make sense. But again, negative in the depreciation, accumulated depreciation side, as long as the net equipment value stays positive, that makes sense. So that wouldn't raise any flags. Again, another negative, a negative value on a loan suggests that you overpaid that loan. So again, we don't think that's going on. Sometimes I will see negative values on loans, and most often this is because people have improperly been categorizing interest that they're paying on a loan onto the loan on the balance sheet, where that interest should be going on your income statement. Now, this can be kind of tricky to fix. This is one of the great things of working with an accountant or a bookkeeper. And occasionally you should be checking, do my loan balances match my balance sheet? And then finally, we've flip-flopped the signs on owner investment and owner draws. Owner investment, that's cash you put in, that's equity you are injecting into your company, that should be positive. And then owner draws, money you're taking out of the company, that should be negative. Finally, the most egregious issue of them all is that our assets do not equal our liabilities and equity. Therefore, our balance sheet does not balance, which is what it is supposed to do. Here we have one other way to generally check the health of your business. This is a ratio that you can pull just from looking at your balance sheet. It's called the debt to equity ratio. And I like this one because, again, the formula is in the name. It is the total liabilities divided by the total equity in your company. And it's telling us how financially stable is your company. So for Craig, he has about 33,000 in debt on the balance sheet, and then he's got about 40,000 in equity. So his debt is lower than his equity. We like to see that because that says that he has built up more than he owes currently. That being said, depending on your stage of business, you may be higher, especially if you're a younger business and you had to borrow money just to get started. That's really going to hurt this ratio. And if this is a ratio that continues to climb as you grow, then this is a big sign of financial stress. But of course, this ratio is really stacked against early stage business because you haven't built up equity in the form of recurring profitable years that would be reflected in your retained earnings. So, this is one reason why a lot of banks really prefer to lend to businesses that have been in business for more than 2 years. You're more financially stable, not just by this ratio, but just in your general operations. And also, if a banker did want to look at this, they're probably not going to just look at one balance sheet snapshot and be like, okay, we're good, they're going to want to look at maybe the prior period, a prior year, and see that you've remained consistent in this debt to equity ratio. But this is not all that helpful if you are a brand new baby business with less than 12 months operations. So that is our section on our balance sheet. Now, do we have any questions on understanding what's an asset or a liability, the equity section, anything around that debt to equity ratio, any
Um,
account classifications or balance sheet terminology, any issues at all? And I'll pause. No questions yet.
I don't think there's any questions right now. For participants, just we encourage you to ask questions and then, we'll be getting to them in the next pause. So we can't do answer questions right away because it would interrupt Kara's flow. But we can definitely stop after a little bit and get to
Or
all your
it was
questions.
just really clear and they all understand balance sheets. So um, now we'll move on to the cash flow statement. Now, I feel like I'm probably losing you guys because questions are slowing down and this is heavy, boring information, and nobody started their business because they loved financial statements. Most of you start your business because you're really passionate about what you actually do, and all of this extra stuff is extra. But with that, I will say that the cash flow statement is my favorite statement. This is actually giving a lot more information on where your money is going. And what's cool to me about it is that it's connecting our profit and loss statement to our balance sheet. So kind of draws everything together. Now, it is showing you over a given period. So similar to our income statement, unlike our balance sheet, it is another kind of movie. It's showing actual cash moving in and out over a time frame. It can be confusing because when we compare it to our balance sheet, what we actually see in a category is like if we see May negative 500, that means there is a change in cash in that account. So we're going to look at an example, but cash flow statement is really saying how much did cash move within each account over the defined period. Now, the key concept here is that a lot of companies come to me and their income statement looks great. They are profitable, right? They've got a lot of taxes to pay. Maybe they're stressed out, but they don't have cash in their personal bank account. Why are they, not earning what they think they should? And cash flow statement, this is most often broken up into our operating activities. That is all related to day-to-day business operations. Our investing activities. These are equipment purchases, and investments. So investing, think about this as you investing into your business, investing into growth, purchasing stuff. And then purchasing, when I say purchasing stuff, I should say purchasing like big capital equipment, things that are expensive and depreciate with time. And then financing activities, that's where we see loans, your loan payments, and we also see your owner draws or distributions. So the critical point here is, of course, that revenue is not the same thing as cash received. Your cash flow statement is going to show you your change in your bank account balance month over month over month over month. Quick note here is that there are actually two types of cash flow statements, and different accounting softwares might use different ones. Because QuickBooks generates statements that use the indirect method. This is what we show. This is what we're going to show today. And these are structured by taking that net income from our profit and loss statement, putting it at the top of our cash flow, and then adding or subtracting any other operating adjustments. And we'll show that in an example. The frustrating part about this is that it is way less intuitive for a business owner to look at and really understand that operating section at first. You get used to it, but compared to the direct method, it is more difficult for me because I'm used to the indirect method, but the direct method would show actual cash receipts and payments across that operating category. And is nicer, but I think there's certain accounting platforms that might use that. So if things look a bit different, that could be why. So now into an actual example, similar to our profit and loss statement. Again, I like to look at this over multiple months broken out. So it's nice if you're producing statements in QuickBooks to generate it this year to date, but then have it separated out by month so we can really see what's happening through those trends. And just like I discussed, this is broken out into our operating activities, starting with that net income with adjustments. So because this business, again, is using some accrual-based techniques, we see AR, AP, and prepaid insurance. If you are not using any accrual techniques and you are pure cash basis, you will not see any of that. But you might still have adjustments for depreciation. The reason depreciation is here is because depreciation is talking about those big expensive assets that your company owns losing value over time. And we put those on your income statement because it does technically affect profitability and you get to deduct it from your taxes, but you're not actually like paying $800 a month for that asset losing value. So to translate this under a cash flow statement here, we get to add an additional $800 to your cash. So that's what's going on. I'm not going to get into too much detail on the AR, prepaid, and AP calculations unless there's questions, because again, it's more advanced, and it might not affect a lot of you. But again, keep in mind, these are all showing the changes in what we see on the balance sheet. How did the balance sheet account go up or down compared to the prior period? And then we see our investing activities. This is everything that Craig purchased in terms of big, expensive capital equipment over time. So these are all negative because when he purchased them, he used cash. And then we see financing activities. We see the negatives of equipment loan payments. So he didn't take any new loans during this period, from what we can tell, but he did continue to pay a loan down. And he took owner draws. So finally, we can see what Craig has been paying himself monthly. We can see it's not the most stable. And then a lot of most cash flow statements will also end in this sort of summary, which is showing a net change in cash with cash at the beginning of the period, cash at the end of the period. Something to note here, again, how this connects to our balance sheet is if we look at our balance sheet from August, and I'm actually going to flip back to our Craig's balance sheet, we can see the total bank accounts. This is the August 31st balance sheet, one point in time, 14,193. And we flip all the way back to our cash flow statement. Here we see that exact same ending cash balance. So we already know, even though we don't have the balance sheet as of those prior months. If we did, this is what that cash amount would be equal to for January 31st, 2025, etc. So broken up again, just in a bit more detail for Craig's particular business. He could look at all of these individually and try to understand, all right, what is going on? Does the net income make sense? That looks pretty good. $28,000 net income. Maybe that's what he expected. Maybe it's low. Again, this depends on what's going on in his life, but we can see across those 8 months that are reported, how much depreciation was accumulated. We can see how much his AR increased. So again, AR is, because this is super confusing, again, I said I wouldn't go into it, but here I am. A negative number on accounts receivable is showing that you're actually increasing that account value, which means it's growing, which means compared to the beginning of the year, customers owe you more money. So this is something concerning to watch if you use accounts receivables. It can happen as a business grows. It might be normal, or it might signal that you are not collecting your cash from your customers as well as you should be. Now, all of that comes together. We're not going to get into each of those, but you get net cash from operations. So already, this is different from that net income. The actual cash change from operations over the period was higher than what we see here. Investing activities, that took away a lot of our cash. So if you're asking, hey, how come if my net income statement said I made $28,000, how come I didn't get to pay myself $28,000? Well, he spent almost $12,000 on equipment purchases. He also spent more than $5,000 on equipment loan payments. And then this is what he was actually able to transfer into his personal bank account. So even though over this period, $28,000 in net income, the change in cash over that time was a loss of 8,000. Now, the question for Craig would be, are we okay with that? Or should we be concerned? Now, he may have good explanations, but if I were working with Craig directly, one of the first things I would work on is, how do we get your collections back up? How do we make sure that your customers are paying you on time? Because we know from his balance sheet, he's got like $18,000 floating out there in the world that needs to be collected. That's going to make a huge impact on his cash. He's paying down his loans. That makes sense. But again, the lesson here is that your business can be profitable, but if you start really heavily investing in equipment purchases, if you have outstanding loans, God forbid you have a lot of credit card debt, you can really be suffering when it comes to your business cash flows. Some red flags to look at, and I apologize for how small this is here, but if you're looking at your cash flow, there's some red flags you can be looking for. Like I mentioned, if you use accounts receivable, you should absolutely be watching your accounts receivable. If you're seeing these negative numbers month over month over month, that means your accounts receivable is consistently getting bigger and bigger and bigger. And it means that, you've got cash out there in the world that is owed to you. If in general you had negative operating cash flow, this isn't Craig's problem, that's also a big concern, right? That could still, in theory, happen for a profitable company if, again, a lot of it would have to do with really poor collections. Now, if you are, and this is what we might call working capital. If we're consistently draining cash, if your accounts receivables are growing faster than you're paying bills, that's where some folks can get into trouble. But in general, one thing that's easy to look and doesn't take a whole lot of major complexity is just looking at this change in cash month over month. What is happening to your change in cash? Why was there this big negative? Well, you can see in March, that was a big 1 month cash loss of 8,000, but maybe that was necessary. Maybe he had to purchase that $8,000 piece of equipment. Or maybe at the time he just looked at his bank account, was like, oh, I've got $20,000 and now's the time I want to buy it. So again, it really depends on what's going on. Something I would look for though, is if we're making big investments through equipment purchases, do we see a resulting growth in net income? And here the answer is kind of like maybe, it depends, but we want to see that investing activities are actually helping grow your business. And then the other thing we want to check is, are you affording your owner draws? So he started out at 2,500, and then over the course of the year, he decided to grow that a little bit. And then I think, you could imagine in August seeing, ooh, my cash balance is dropped a little bit lower than I want it to. It took a slightly lower owner draw. So, and something else to note is that if you're applying for a loan or you're planning to apply for a loan, a lot of lenders, they want to see proof that you have been paying yourself regularly as the owner. And so getting yourself into a place where you can afford to take consistent owner draws just makes you look like a much more stable, trustworthy business to a lender. Here's another tool that can be used if we want to just take some quick reads for patterns. I could go through each of these, but that's going to take a lot of time. And we've got about 20 minutes left. So I'm going to skip ahead and look at just a couple of sub-examples. So if we look at our cash flow statement, and we look at our 3 sections, we've got our operations, our investing, and our financing sections. Those are the 3 areas to think about. each of these sections, all we want to do is put a plus or a minus next to what's happening. So this is over the same 8-month time period. And we see for Craig's business that the net cash from operations is going up. We see that the net cash investing is going down, meaning he's spending money and investing in his business, buying equipment, and the net cash from financing is going down, which means he is paying himself and paying loans. So this pattern is technically a sign of healthy growth because you're operating in the black, you're using the cash that you're making to invest in equipment, and you're paying down debt and paying yourself. So overall, this is a good sign to see. There are other patterns that would be scary or potentially scary, right? If we're seeing that your net cash from operations is negative, that means, and we see investing is positive, then that means that you are losing out on sales, you're not profitable, and then we're seeing you selling off your assets. This is a warning sign that you're struggling. And then if we also see positive in financing activities, that means you're borrowing. So you're losing money, selling assets, borrowing to survive. Something is going wrong. And then another pattern might be if everything is positive, right? Your operating activities are good, your investing activities are positive or zero, means you're selling stuff or not investing. Your financing activities are positive. That means you're getting loans. But what we're seeing is that you're making money, but you're selling stuff and you're taking on new debt. How are you investing that into growth? So, it's not a good or a bad, but potentially there could be some room for improvement. So again, I recommend afterwards you can take this slide, look at it in detail, pull up your statement of cash flows, and see which category you fit into. All right, so that is our cash flow statement. We do have one more section, which is on how these three statements connect and work together. But happy to address any questions that pop up. And Lena, I can see the chat, so if folks are quiet, I will keep rolling through to the next section.
Sounds good. Someone asked, what do you consider cash money in the account or cash from accounts receivable, not yet paid?
What do you consider cash? I consider cash in your bank account, period. So your balance sheet, this is why we care so much about collections, the timing of bill pay, and we care about being able to check this number right up against your bank account. So this cash end of period, that 14,000 we see, that is what your bank account reads. So and the thing is that there are some companies who have accounts receivables that have been on their books for years and they've just never cleaned it up. If you see that your accounts receivables are growing and growing and growing, you might not be able to ever collect that money. You might not, the customer may have moved, changed phone numbers. That needs to be written off as bad debt. So depending on what's going on with Craig, towards the end of the year, he should work with his accountant and decide, is any of this cash that I should have received from customers, should I write this off and say it's not collectible? This is super common. Yeah. There's only so much you can do. Most businesses are not in the position to sue customers for not paying them, unfortunately. Unfortunately, I guess.
And then, so no operating expenses or other expenses are included in the cash statement?
So all of your expenses are included in the cash flow statement. You just don't see them. They're all included because they're here in this net income line. So again, remember, net income is your revenue minus all of your cost of goods sold, all of your operating expenses. This is just the cash that's left. So it's there, but it's kind of embedded.
Thank you, Kara. That's it for now for questions.
All right. So how these three statements connect. And I've mentioned this a few times throughout, but to give you a visual, typically we start with our income statement. And our income statement gives us that net profit, that net income. And then this isn't, I borrowed this visual from Cash Flow Mike, but this statement of retained earnings, this is really just a piece of our balance sheet, right? This is our balance sheet. Retained earnings is a combination of what your retained earnings was before, plus any new net profit. And you don't have to worry about dividends because you're not paying out to shareholders. But if you did, they would also be within your retained earnings. And all of that rolls up. So indirectly, that income statement is funneled into our balance sheet. So that's one connection. Then our statement of cash flows, as I mentioned, is connected to our income statement through that net income typically being part of this operating calculation, but also it's connected to our balance sheet because the ending cash is the top of your asset section. So this is one of the benefits of using an accounting software like QuickBooks or Xero or one of them, is that QuickBooks won't let you not have these things balanced out. It might have them balanced out incorrectly. It might have, incorrectly, you might have too much in one account and not enough, and that can all be fixed, but it's all there somewhere. And so it's just a matter of sorting it properly. Versus if you're doing this by hand, it's easy to leave stuff out, and you might have unbalanced books. So again, all of these are connected. Your net income from your profit and loss becomes equity on your balance sheet. Your balance sheet must match your cash flow ending cash. Your profit and loss depreciation also affects those equipment balances on your balance sheet, pulling down the value of those assets. And then your cash flow statement is showing those changes across all of your balance sheet accounts. So if you don't, hopefully that is one clear takeaway you can leave today with. Now, this is a very wordy slide. I apologize, but to put this all together on what we can learn from Craig's 3 statements, what happened over this 8-month period? We see that Craig earned $28,000 in profit from operations, but we also see his cash decreased by $8,000. So we get that from the income statement, the sentence, Craig's business earned $28,000. From the balance sheet, we get different information. We can see that Craig has $14,000 in his bank account. We can see that he is owed $18,000 from customers. We see he has $42,000 of equipment value, that he owes $32,000 through credit card loans and other liabilities, and that over time, since operations began, his business has accumulated $44,000 in equity. Now, cash flow statement, this explains why his cash went down despite profit. We start with that $28,000 in profit, but we see that cash is tied up in receivables. We see that he spent money on new equipment. We see that he was able to pay himself and while paying down loans. But we also see that he was able to add back in some cash because of those depreciation, prepaid insurance, non-cash expenses. So there's a lot going on, and we have to look at all 3 statements to pull this all together. Now, the connection here again, income statement is showing his business profitability. The balance sheet is showing a snapshot as of the date the statement is pulled, in this case, August month end. And the cash flow statement is explaining the movement between the starting cash in the period to the ending cash at the end. Now, there are additional ratios that you might need to reference multiple reports and that might be important for different businesses depending on where you are. One that I see a lot is referred to as DSCR, which stands for the Debt Service Coverage Ratio. And this is often a cutoff for a lot of lenders. For example, for traditional bank loans, non-SBA bank loans, they want to see that you have a DSCR of at least 1.25. Now, it is helpful before you look into applying for loans if to see if you're even a suitable candidate for a conventional loan is to check, how have things been going. So we can do this by looking at Craig's his Craig's profit and loss statement and his cash flow statement. So we do need those two statements together. We can see that his net operating income over the 8-month period was about $28,000. And we can see his total debt service. We have to take the $5,200 from his cash flow statement, him paying down the principal, and add the $2,240 from his interest payments, which is on his income statements, together to get $7,440. And then we can divide that operating income, the $27,830, by the $7,000 to get a DSCR of 3.74. So 3.74, that is great. That means he is in a strong position for conventional loans, assuming all these other factors make sense. Now, where we see folks get into trouble here is if your business is not profitable, not generating enough operating income, and you have a lot of outstanding debt, credit card loans, high interest rate debt, line of credits, whatever it is, most traditional banks are not likely to give you a loan to do anything. And this is where we see a lot of businesses really struggle. Fortunately, there are specific loan programs that are intentionally designed for debt consolidation. I do want to warn that there's also a bunch of really crummy companies that are out there offering really high interest debt, calling it debt consolidation. So be careful about the company you approach. But if you find yourself with a really struggling DSCR, meaning you can't cover your debt payments, it's a good time to talk to an advisor, see if you might be a candidate to go through maybe a CDFI, community development financial institution, who really helps business owners who have, for one reason or another, gotten themselves into a situation where they have more debt than their company can afford. That's a full aside, but again, why lenders care more about DSCR than debt to equity is that it truly shows your current capacity to make payments on your loans. And lenders are all about managing risk. So most traditional banks, they want to see that if we loan you money, will you be able to comfortably pay it back? So again, in order to get to this, you need to have clean financials. You need to know where to look for stuff, and you need to understand some of these basic definitions. All right. So I think I've got one quick question, and then we're going to do a quick wrap up, and we are all done, and we're going to be on time today, Lena. Now I see a question referring to investing activities versus financing activities. So this is from our cash flow statement question section. Again, if we look at the big one. This is split out by these categories. So most cash flow statements will have this header: investing activities, financing activities. Investing activities are really you making investments in your business. And I know this is not the most intuitive piece, but most commonly investing activities are you purchasing capital equipment, or like you could be purchasing real estate, or you could be, if you rent, tenant improvement, leasehold improvement is another investing activity. Like you pay a contractor $20,000 to build a kitchen or whatever it might be. These are long-term expensive capital things where you are either purchasing new, or you might be selling off existing equipment that you have. Versus financing activities. This includes taking out cash to pay for your through loans. And typically these happen kind of at the same time. You have some financing activity, you get a loan in order to purchase equipment, and then you see that change in that investing activity. But really there's those two things happening. The first is cash in, and then cash out. And I'm seeing the questions come in. So a quick note, The sign here is telling us the direction of cash. So remember, cash flow statement is showing us literally what is happening to cash. So a negative number in investing activities, meaning your cash, the cash transaction is negative into your bank account. So if you are purchasing capital equipment or spending money in this category, you're spending money. Cash is going down. If you are selling equipment, then cash is going up. You are losing that asset, gaining cash. So here we don't see Craig sell any equipment. We just see him buy equipment. And yeah, I think that should make sense. Similarly, we see negative loan payments because Craig is taking business cash and repaying a loan. But if he was receiving cash, getting a loan, then that would be a loan income. That would be a positive number on a financing activity. Okay. Let me go back to where we were. Let's see. I've got the next one. So it says I have a D&B account. Okay, so we're talking about business credit. Of course, they want me to upload all kinds of statements and other info that would make my company more credit worthy, etc. Is it really that big of a deal? I have no plans for loans. Is this just them being pushy? I love that question. It is you. From even talking to lenders, they care more about your personal credit score most of the time as a small business owner than they do about your business credit score. That said, they'll look at it. It's nice to have, not a need to have. Depending on what type of business you're in, there might be reasons that somebody might look at it and use it to assess the credit worthiness of your business. From my understanding, though, for the most part, people are more trying to stay away from businesses that have big red marks that are affecting their business credit, like they haven't made payments. So if you had something going on that made your business have some negative marks on your business credit score, it might be worth jumping through the hoops to make your company more credit worthy. But probably if it doesn't feel worth your time, it probably isn't. All right. I do want to skip ahead to our quick wrap up and then I'll finish off the rest of the questions. So with putting this all together, what can you do to start using some of the things we've talked about today? Step one is just if you don't have access to your reports, or if you don't have a bookkeeper sending your reports, to start getting into the habit of at least generating or at least looking at these reports in your QuickBooks or whatever system you're using. QuickBooks is nice. I like to use the automated feature where at the end of the month, or the first of the month or whatever it is, or maybe depending on when your books close, again, you can set the timing and have it email you your reports directly from QuickBooks. So it pops into your inbox. You're like, oh, now is the time for me to review these statements. And if you don't normally look at them, start looking at them for where you are for the year. If you're having trouble understanding what's going on, it's a great opportunity to reach out to an SBDC advisor, your Capital Pathways advisor, and have them help you go through in detail what is going on your statements. Once you have access to them, you want to do a quick sweep, just your data quality. So like I said, the first thing I like to look at is, does that cash balance on your balance sheet match your bank account? If not, that's a good place to start. Now, you also should, as a business owner, have a good general sense of where your revenue was, where your expenses were. So take some time and, does this align with what you thought happened last month? And if no, are you missing something? Was something reported wrong? Did you forget to bill a customer or something like that? So, you don't need any major financial background to just do some basic checks and make sure you understand that cash in and out. Next, you could use some of these more advanced tools or built-in tools that we talked about today. That debt to equity ratio, is that under 2.5? Is your DSCR above 1.25? Do we see that cash flow pattern looking like it should? And are our trends generally moving in the right direction? And that all of this is useless if we don't take action based on what we see. So if you see some concerning trends, maybe consider using that expense control rule, which is that if you see your gross profit is going down, maybe we need to cut some operating expenses. As a business owner, cutting operating expenses should be just by default something you're looking out to. Where can you save cash? Where are you spending cash that you shouldn't be? And then identify at least one action every month that can help improve cash flow somehow, whether that's by increasing revenue, improving your cost of goods sold, decreasing operating expenses, getting your debt payments under control. Just starting with one small action can help get you into a really solid pattern around taking control of your business financials. So now let's say that Craig took this training, paid attention, took good notes, rewatched the recording. What happened? We can say that, Craig is now not just filing away his statements, but he's actually taking time and looking at them. Maybe he's even able to catch some mistakes that were missed by his bookkeeper, because the bookkeeper doesn't have all the context that you do as a business owner. He started to use some of the trends to quickly spot problems. He was able to cut his expenses, which was really starting to drag him during slow months. And he was able to talk to lenders and feel really confident bringing up debt to equity ratios, his debt service coverage ratio. And he was able to manage the tight cash position really, really proactively rather than reactively. So we can update his monthly routine. He started doing financial checkups every month, starts by checking the numbers make sense, uses the visual tools. And this is where, if you're using a bookkeeper, it's so crucial to be comfortable asking questions and getting that bookkeeper engaged to help you manage your business. So now here's a quick fake testimonial, but hopefully this is where I'd like you to be at the end of this, that maybe you felt scared of your financial reports, but really they're just telling you a story. And as a business owner, you need to understand that story, especially when cash is tight. So here's some action plans. This week, locate your most recent financial statements. Figure if you don't have those, let's get on track to make a plan so that you can generate them. Now, not all businesses have a lot of assets or a lot of equity or liabilities. And so you might be able to get by just using your profit and loss statement and a statement of cash flows. But this is something you can talk to an advisor about specifically. You can try, if you have access to these statements, to check some of your ratios. You can take this plan, you can print some of the more helpful slides and put them at your desk. And then over the next 30 days, you can set up your plan, block your calendar, set up like a monthly reporting schedule, and try to do that first monthly checkup, assuming your books are closed on a good date. Little things, calculating your gross and net margin can help. You can identify your cash flow patterns, apply the rules, and then for next quarter, you can look at working with a bookkeeper, an accountant, or advisor to address any data quality issues and try to improve the systems you have. And if it makes sense, you may be ready to address funding readiness and think about loans if it makes sense for your business. Again, not everybody needs a loan, but they can be really critical in unlocking a business's potential. So linked here is I don't think I can click on it in presentation view, but this is our, this will link you to a Google Sheet, which will bring up the exact statements that I screenshot today. And once you have this PDF, so you can download that, use it for what you will. I recommend scheduling a session. You can also check out these upcoming webinars. We've got one November 4th, QuickBooks 101, SBA loan programs, November 25th. I am back on December 9th with basic business financials. If anything just felt overly complicated today, I might recommend taking a couple steps back and looking at and joining me on that webinar. then more SBA loan programs, and then this December 18th LLC S Corp partnership business structure stuff. Now, back to the questions.
Thank you, Kara. I see two here. If Craig was selling equipment, not buying it, would it show up in the income section of the cash statement?
Absolutely, yes. So if, and this is kind of the fun part of playing with these reports, say, because we have, now that we understand how all these statements are going, let's imagine I'm going to adjust this so that Craig purchased an equipment, or sorry, sold equipment in, let's just say July. Maybe he sold this I don't know. So he sold something for $2,000 in July. So if I put this $2,000 here, we see that's going to increase his cash, right? Now this has created an error in my sheet because this is not connected to QuickBooks, because whenever you do one thing, there's another impact. So by selling that equipment, let's think about what other statements that would have affected. It would have affected his cash on his balance sheet, because now cash just went up by that $2,000. So I'm going to undo all these changes because I'm really messing stuff up. But now our cash is at 16,000. So I can check. Now that matches here. So I have this check built in that does this match our balance sheet? Yes. But another thing that happened was now our balance sheet is out of balance because cash went up, but we also had an increase to equipment, or a decrease to equipment, again, of the same value. So that's 28,000 minus 2,000. This is really getting into the weeds, but I feel like it's fun. So now I can see that by those changes, I was able to make the appropriate adjustments to the important statements based off of that sale. So when we look back at our statement of cash flows, yes, we see that positive 2,000 connected to our balance sheet that increased our cash, and also decreased our assets. We see a bunch of changes kind of looping through.
I think you kind of responded to the second question of, could you please go over how the numbers are connected across financial statements, P&L, balance sheet, and cash flow? You just gave an example, but maybe um, you can expand a little bit more.
Yeah, absolutely. So if this is a tool you want to play with, as I said, when you get the PDF of this PowerPoint, you'll see, and I'm just undoing those changes just so it matches the PowerPoint again. You'll see a link to this on one of the slides, but on the last one of the wrap up slides at the very end. And with it, I add in these little checks here that are showing us some of the main connections. I mentioned there's a few connections, but some of the main connections, if we're looking at our P&L, first check that I have built in is, does the net income here at the end, does that match our statement of cash flow? So these two numbers match. So that's why this says check. Now, if this number, I'm just going to break it for a second, was 40, now this is giving me an error. So I know something was wrong. So I spent some time with this sheet to make sure all of the, because I had to build these, so I had to make sure that they were all doing what they were supposed to be doing. So that's one check. If we go to our balance sheet, we have another check here. This is actually just checking, does this balance? But any of the green numbers, these are connected to other sheets. So this green number is a cell reference to our P&L. So it's coming from right there. These numbers, this total bank account number is being put into our statement of cash flow right here. So this other green number is showing the ending cash balance at the end. But there's some more subtle ways that this is connected, because we only have an example balance sheet from one day, but this accumulated depreciation here, that includes all of this accumulated depreciation over here. No, sorry, the accumulated depreciation here. So we can see there is $6,400 of accumulated depreciation. here we see more because the balance sheet is representing a longer period of time. So it's not a direct link, like a formula link, but they definitely are impacted. Yeah, similarly, prepaid insurance, that's connected into our balance sheet. So I recommend just kind of spending some time and looking like what account names are repeated across and what's going on. And yeah, spending some time breaking the formula. You can download this, do whatever you want, going from there.
Thank you, Kara. I think that's it with questions, and I know we're a bit over time, so I wanted to give a huge thanks to Kara for this wonderful webinar, and just repeat that you will be getting the slides and recording of this webinar via email. And also you can sign up for one-on-one advising support through the link that I sent in the chat. You will also have that link and information in the follow-up email that you receive. And if you have any other questions or support, you can reach out directly. Thank you again, everyone, and thank you especially Kara for all this wonderful information.
Bye.
Have a great day. Goodbye.